Hello, and thank you for tuning in to the Sunoco LP investment video, a part of Tulane University's Burke and Road Reports program. Our analysts include Patton Koch, Sophia Corcel, Daniel Rodriguez, Federico Segura Escobar, and Catherine Speltz. Our investment research manager is Jimmy Skipton. As a team, we established a 12-month target stock price of $33.13 and a rating of market outperform for Sunoco LP. In this presentation, we will give a brief overview of Sunoco LP, and then we will give you an overview of the industry, some recent developments, our industry thesis, Sunoco LP's financial performance and projections, our valuation, and lastly, our conclusion. Sunoco LP is a Houston, Texas-based American wholesale and retail distributor of motor fuel founded in June 2012 by Susser Holdings Corporation. While the company primarily profits from the wholesale distribution of motor fuel to Susser and other third parties, the company now owns and operates nearly 850 convenience stores and retail fuel sites across the United States. Sunoco LP's retail segment operates 855 convenience stores and retail fuel outlets in Texas, New Mexico, Oklahoma, Virginia, Maryland, Tennessee, Georgia, and Hawaii under several brands. The convenience stores offer a variety of food, beverages, and non-food merchandise. We arrived at our 12-month target price of $41 per unit using an equally weighted average of the price-to-book ratio model, the price-to-distributable cash flow model, and the dividend discount model. We used a 0.52 multiple for our price-to-book value model based on the value in the first quarter of 2016. Our estimated book value for 2017 is $2.93 billion, and our 12-month target estimated price is $30.12. In our price-to-distributable cash flow model, we used a 14 times multiple for our distribution per unit estimates and obtained a 12-month target price of $14.87. The dividend discount model is a well-known valuation model that values the company at the present value of its future cash flows. In our model, we assumed a quarterly distribution of 80 cents for 2016 and 2017. In 2018, 19, and 20, the distribution grows 3.5% annually. We calculated a discount rate of 12.47% using the CAPM model with a market risk premium of 9.84%, a beta of 1.25, and a liquidity risk premium of 3%. We assumed a terminal value of $37.91 and a long-term growth of 3%. The estimated 12-month stock price is $47.77. As shown in Figure 1, the weighted average was $41 per unit. Our revenue model is broken down by retail and wholesale revenues. Retail revenue's main driver is the number of owned and operated stores, which include Sunoco, Stripes, Aloha, and Mid-Atlantic stores. We held gallon per stores constant, as well as merchandise sales, rental income, and other income per store. If the company successfully introduces Laredo Tacos to its northeastern stores, merchandise sales could increase, but would minimally affect our revenue forecast. Wholesale revenues were estimated by multiplying the number of consignment and third-party locations by the gallons sold per location. The wholesale fuel prices were estimated as a ratio of retail fuel prices. We estimated the construction of 20 new stores during 2016. This assumption is in line with the company's plan of building or acquiring 20 new stores per year and buying new land to keep between 20 to 40 land properties in its land bank. We do not expect Sunoco's operating expenses to change dramatically from the current structure and assume the same common size ratios as 2015. Our model also includes the issuance of $2.2 billion of longer-term debt to pay Energy Transfer Partners for the remainder of the dropdown. Sunoco LP has a 5% market share of the wholesale motor fuel industry. The industry is characterized by extreme competition and fragmentation, which can result in narrow margins. Sunoco LP and competing companies in the industry purchase petroleum products in large quantities and sell the commodities to retail channels at an amplified price, allowing them to profit from the price premium. Most recently, Sunoco LP was considered for sale due to the tumbling stock price of ETE and its required payout of $6 billion. ETE was considering the sale of Sunoco in addition to the sale of its 36.4% stake of ETP's interest in Sunoco. This rumor has been quieted, but if ETE were to receive new interest, the possible Sunoco divestment might become more probable. In November of 2015, Energy Transfer Partners LP dropped down marketing and wholesale fuel assets to Sunoco LP, and Sunoco believes it will not need to raise additional equity financing in 2016. In December of 2015, one of Sunoco LP's wholly owned subsidiaries completed the acquisition of a wholesale motor fuel distribution business serving the northeastern United States from Alta East Inc. This transaction will contribute to Sunoco's growth in the Northeast. During the third quarter of 2015, ETE announced that it would create a new affiliate that would acquire Williams Company. The former CFO of ETE, ETP, and Sunoco LP were fired due to their opposition to the Williams deal, and as a result, the Williams and ETE stock decreased. Sunoco owns two long-term, fee-based contracts with affiliate Susser Holdings. These commercial agreements deem Sunoco LP as Susser's sole distributor of motor fuels to its existing Stripes convenience stores in independently operated locations. 420 of the stores owned by Sunoco LP fall under the Stripes branding and currently operate a Laredo Taco Company, a restaurant inside of the convenience store. These restaurants have acted as a major driver of retail sales in-store. The handmade tacos sold by the Laredo Taco Company encourage the purchase of beverages and other high-margin food and merchandise goods. Sunoco LP understands the value in these stores, and in the past year has opened 40 new Stripes locations, all including a Laredo Taco Company. By expanding into the convenience store industry, Sunoco LP has been able to diversify its business structure and provide a stable form of revenue. As fuel prices have fallen in an almost unprecedented fashion, most commercial entities related to the production, transport, and refining of oil have taken significant losses. But, due to Sunoco LP's diversified business model, the company has mitigated some of the adverse effects. The dropdowns from ETP and the acquisitions made throughout the year have increased revenues for Sunoco LP and expanded the company's footprint. Sunoco LP increased its revenues through the acquisition of Aloha Petroleum Limited and through the dropdown of Mid-Atlantic Convenience Stores, MAX, in 2014. In 2015, the company experienced additional dropdowns from its parent company, ETP, and will continue to see an increase in revenues. To conclude, we can confidently forecast a 12-month target price of $33.13 per share and a rating of market outperform. The long-term fee-based contracts between Sunoco and Susser Holdings Corporation will continue to provide stable cash flows, and dropdowns from ETP to fund acquisitions will greatly expand Sunoco LP's footprint. The expansion of Laredo Taco Company, in addition to low fuel prices, should lead to continued growth in merchandise sales and make new store openings even more profitable. Thank you for listening to our presentation. If you would like more information about our report, you can find the full report on the Burken Road Reports website. The Burken Road Reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice. Investors should not regard the reports and presentations as recommendations to sell or buy any securities mentioned. Investors should consult an investment professional and/or conduct their own primary research before making any investment decisions.